Welcome to Wealth Roadmap with Jeff and Steve, your guide to simplifying wealth management. Join us as we explore financial planning, taxes, investments, insurance, and legal frameworks to help you secure your financial future. Welcome to Episode 8 of the Wealth Roadmap with Jeff and Steve.
My name is Stephen Benny. Glad you could be here tonight.
We're gonna crack open a cold one. It's gonna be a good episode, but don't worry, this is a Wealth Roadmap seltzer.
It's actually
We're gonna dive in. It's only a Wealth Roadmap seltzer because we don't have any sponsors yet. So until one of these big name brands starts to sponsor our podcast, it's a Wealth Roadmap seltzer. So, Steve, 6.5 compelling reasons to roll over your 401k into an IRA. Are you ready to dive in?
6.5.
Yes, 6.5. And you're going to want to stay to the half. That's going to be at the end, and that's going to be a cliffhanger. Pretty interesting. We're going to have Steve go over that one. But
I get the half.
Let's start with number one. Steve, give me one reason why it's a compelling reason to roll over your 401k into an IRA. And now, before Steve actually does dive in, you may work for a certain organization that doesn't have a 401k. Maybe it's a 403b, maybe it's a SEP IRA, maybe it's a simple IRA, but we're going to refer to 401k as your workplace retirement vehicle. So if you hear us say 401k, again, this may still apply to you if you have a 403b or any other type of retirement account through your employer, if it's an annuity through your local union, whatever it might be. So, Steve, the one thing I wanted to mention right before we kind of dive in is when you transfer money from a 401k or a 403b or any retirement vehicle from your employer into an IRA, it's not a taxable event. That money goes from retirement account to retirement account. You don't pay any taxes. The only time you're going to pay taxes is when you actually take that money and you put it into your checking account and you go buy something or use that money. But if it's going from retirement account to retirement account, it's not a taxable event. And that's a pretty big concern that we always hear from people is, well, am I going to have to pay taxes on transferring my $1 million from my 401k into an IRA? And the answer is no, if done properly.
Bingo. That I was just going to say, if implemented correctly, and especially if done, the key is to do it a direct trustee to trustee transfer or a direct transfer. That is the key. So just remember that term, and if implemented properly, you nailed it, Jeff. Great point. I'm glad you brought that one up.
So, Steve, let's knock their socks off and start off with reason number one on why someone would consider rolling out their 401k into an IRA.
Reason number one, simplicity. I think this is probably one of the reasons where it just makes things easier, especially if you have a bunch of different retirement accounts. It's one of the things we see, right, Jeff, where, no longer really are the days where people are working at one company for 20, 30, 40 years and then retiring. People are working many different jobs. So they may have multiple old retirement accounts, as you mentioned, Jeff, 401k or 403b, etc. So I'll just kind of use the term retirement accounts for right now. So if you have multiple retirement accounts, it kind of could get a little onerous as far as figuring out where they are, what the balances are, signing into each one. And there's different apps to connect different types of accounts so you can see them all at one place. Yes, but typically those apps don't show all the full details. So at one point you may have to start to log in. So the bottom line is consolidating your retirement accounts into a single IRA, or maybe if there's for reasons where you have different beneficiaries and you want to have more than one IRA, having at least one or two versus three, four, or five different retirement accounts just offer simplicity, ease of management. You can be more organized. It's more streamlined in the planning process. And when you do consolidate those assets into an IRA, number one, you kind of get a better idea of where you're at, a more comprehensive view of where you're at, of your overall financial picture, and it's easier to monitor your progress towards any goals that you may have set, or if you need to adjust your strategy, you can do so, and it's easier to do so. You can, instead of having to adjust each account and making sure that all your assets are kind of working in concert, you have one account, maybe two accounts, right, where you can change the investment strategy if you need to, or if a goal has changed, or potentially maybe you get another job and now you have an additional 401k. Yeah, just rolling that over into that one IRA will allow you to maintain that investment strategy that you laid out and just make things easier. And that's the big piece. It makes things easier, simplicity. And I think that, for number one, kind of covers it. So without further ado, what comes after one? Number two, Jeff, give it to us. What do we got? What do we got for number two?
Number two is going to be effortless RMD management. What does that mean? And this is kind of a cue going back to our episode 7 where we discussed RMDs, which is your required minimum distributions, which is again when the government forces you to take money out. Well, like Steve mentioned, it's not, like the days where maybe you worked for one employer for the rest of your life. So if you do have 2, 3, 4, 5 different 401ks and you never take Steve's advice on rule number 1 of consolidating your accounts, and you have four 401k plans out there. Well, now for RMDs, you have to take out an RMD from each of those 4 accounts, and that can just be complicated in itself. So you consolidating, like Steve mentioned, all of your accounts into one centralized IRA is going to simplify your process. Just reducing like the administrative hassle of having to take out RMDs. So number 2 is basically, again, just making your life a lot easier with calculating and executing your RMDs when that time comes. Um, Steve, talk to us about number 3.
Number three. This is one of the ones where I think most people are aware is there's just greater investment options, more flexibility outside of a 401k. Or again, retirement account. When you have a retirement account, you're working for a company, 403b, 401k. What you notice is you're limited to the types of funds that you're able to invest in, right? And you don't have access to the full marketplace of the investments that you could utilize. You have to stick with what they offer, which again, while you're working, and especially if you're getting the match, that's a no-brainer, right? That's, yeah, it's a good benefit to have. The 401k, the retirement account, is there to be able to help you save, to be able to help you invest and get money in, and dollar cost average, doing that however you're paid, whether it's biweekly or monthly, and you get the money into a retirement account over time. Okay, great. But once you're no longer there, well, now you have options to take advantage of a broader range of investment options compared to any employer-sponsored retirement plan. So what does that mean? Again, going back to what I mentioned for number 1, you can customize your portfolio, right? You can make sure that your money is working together, and you have a strategy that you're not overlapping in different investments, and there's not a concentration of a certain type of, whether a stock or asset class, and you're able to actually make sure that the investments you're selecting, number 1, are going to match your goals, but number 2, you can go to any type of investment that is out there. And so that you'd be able to invest into that IRA. And whether it is a different stocks, bonds, mutual funds, managed portfolios, um, ETFs, index funds, I could go on, but you get to choose. You have the option to choose what you want to invest in instead of being told what to invest in. And then from there, tailoring that approach to make sure that the money that you have invested is following what your objectives are and what you've decided based off your financial goals and risk tolerance. And I think that's a big one, is just you get to be able to pick and choose what you want instead of being told what to pick and choose.
Yeah, I think this is probably, for me at least, the one of the biggest reasons why it makes the most sense for you to go from maybe the 20 or 30 different options that your employer is offering to, like you mentioned, thousands upon thousands of options, whether it is individual stocks or whatnot. Your employer may offer a large cap fund, or large growth fund, but that doesn't mean that that's the best one, right? But if you have an IRA, you can go out and, like you mentioned, Steve, throughout the, search the marketplace and, get whatever it is. Same thing with like the fixed fund. A lot of 401ks offer a fixed fund where, they're going to give you a guaranteed, I don't know, 2%, but that doesn't mean that you can't get, something higher on the outside. And actually, this happened to a client of ours. He retired from a local union. He was a conservative investor, had money at that time. I forget what his fixed rate is, but he was able to double it on the outside once he transferred his money into an IRA. Now that's not guaranteed for everybody, but you just have a plethora more of options out there. So that kind of leads us into number 4, right? I mean, number 4 being possibly lower fees and expenses. Now, again, possible. This is going to vary with every 401k. And a lot of times, we'll talk to people and they'll say, oh, no, I don't pay any fees in my 401k. And then I simply ask them, oh, is the investment company that they may be with, are they a nonprofit? And usually they laugh and chuckle and they say no.
You're so funny.
That's why I keep you around, Steve. You laugh at all my jokes. So they
I feel bad. That's why.
But sometimes you can't see the fees that you're paying. Maybe you're in a fund and you see a 10% return, but possibly if there are, hidden fees within that fund, maybe that fund actually returned 11% or 12%, and you're just seeing 10%. And so, being that you don't see any fees coming out of the 10% that return that you got, you just assume that there's no fees. But a lot of times it's a lot easier to control what fees you're going to be paying in an IRA, right? Like Steve mentioned, if there's 20 or 30 different fund options within your 401k, you're kind of limited to them. And if their fees within those funds are higher, it is what it is. But if you could transfer it out into an IRA, and again, now you can choose a fund that might be or might have a lower expense ratio, all the power to you. So, when evaluating your 401k versus an IRA, yeah, you're going to want to not just talk about, looking for a greater performing fund or option, but, what do the fees look like when it comes to the fees that you're paying within a 401k? And again, if they all have, annual flat fees, and again, you have 3 or 4 401ks lying around, well, now you're paying that fee 3 or 4 different times, as opposed to just having one account where you paid that fee once. So there's a lot that can kind of go into that when it comes to the fees. And there's times where, one 401k plan that we may see, might be lighter on fees compared to the other. So that's something that you're just going to want to evaluate. So let's dive
Yeah.
into.
Yeah, Jeff, real quick, just so they know, yeah, right. One of the document that, a lot of times that the statement that you get doesn't tell the full story. So one of the things you can request if you want to actually kind of do a deeper dive into into the 401k and the expenses, the fees is a summary plan description. And that you could ask your HR person if you know who that is. You could probably even go to whoever is managing that fund.
The record keeper.
Exactly.
Yeah,
And
so if it's with Fidelity or whatever company.
Yeah. Again, just if you really want to, because like Jeff, like you mentioned, that's not always the case. Or some 401ks are don't have, or the fees are competitive. So it's something just to do as due diligence, and we often recommend to do that. And whenever we're reviewing for our clients their 401ks, that's one of the documents that we look to get.
Awesome. Talk to us about number 5, Steve.
Number 5. All right. Yes. So what's the big, most people want to stay in control, and right, that's I think, change and making sure that they're in control when we're meeting with prospective clients is an extremely important piece when we're discussing and going through a planning process and discussing recommendations, and we understand that. So you just want to make sure that you have the control. And by rolling the 401k into an IRA, you do get greater control because you can choose. And it's kind of repetitive in a sense, but you're allowed to make the investment decisions. You're allowed to do the research. You're allowed to, if you want to partner with a financial professional and work with them as far as looking for a strategy that's going to fit what you are looking for. You design that based on your individual preferences and objectives. And you can invest, as we mentioned, in different types of securities. So that is the benefit, of being able to roll that 401k into an IRA. It's just that control. And I think that's a big one. And as far as whenever we're meeting with clients, that we want to make sure that, look, it's their plan, it's their money. At the end of the day, we want to make sure that they feel comfortable. And by allowing them to really be the ones who are making the decisions with our input and advice, that is key. That's paramount, especially when we want to make sure that they feel confident that they have a plan that they are in control of.
And
I kind of wrap it up with that, but
yeah, and the control not even just on so much investments that they're choosing, but also custodian or record keeper that it's with, right? If you have a 401k plan and they're with Empower and they decide the next year, hey, you know what, we're going to switch, we're going to go to a Principal or a Fidelity or Charles Schwab, whatever it might be, every employee is getting carried over to them, right? Whereas if you have an IRA, you get to choose which custodian your money is being held with. And that goes, like Steve said, that's, especially in today's world, you want to know, where your money's at. You want to be the one that's controlling it. Because again, if you're leaving 401k dollars at an employer that you were with 15 years ago, that employer might be switching 401ks, platforms, record keepers, let's say every few years, right? Maybe they're getting a better deal in fees or whatnot from that next company. And then, next thing you know, oh shoot, I thought my 401k was with Fidelity. And now you're calling old companies trying to locate that old IRA or that old 401k that you had years back, as opposed to taking Steve's advice on number 1 and consolidating everything.
Yeah, and I just as we're talking to you, Jeff, just an example popped in my mind as far as control can be looked at really in two different ways. Number one, the client having control of everything that they're doing, or just feeling that they are in control when a lot of concerns that we hear over the years, especially when working with people who kind of have accumulated the wealth that they've accumulated, have worked for many, many years, have amassed a nice amount of wealth in different types of accounts. and they've done some really great investing and great accumulating of wealth. But what they say to us is, yes, yeah, we've done well, but there's no plan. I'm really not in control. I don't really have an understanding of a strategy. I don't have an understanding of a distribution strategy for retirement. I don't really understand the tax implications. I have all these different types of accounts. I have some retirement accounts, some IRAs, some 401ks. I have some brokerage accounts, some savings accounts, CDs, some money over here, money over there. It's kind of like the financial junk drawer, right? And in a sense where and that's not a bad thing. The fact they've done so well, they've accumulated all this wealth. But they have some here, they have some there, and they don't feel like they are in control. So consolidating and transferring into IRAs, consolidating some of the 401k, some of those retirement accounts can give them a better sense of control because now they have a plan. Maybe they're not necessarily the ones that are controlling it day to day because they understand that they're good at what they do and they want to have a partner who is good at managing the money because that's what that partner does day in and day out, and allowing that partner to be able to help them have a plan, an investment plan that they are confident in, that they understand, that again, they're not necessarily in control of that on a day to day, but they know that they're in control because their plan has now a direction, and a lot of the concerns that they have had are eliminated, or I shouldn't say eliminated, but reduced because of the planning that has been done. And the consolidation is a big part of that because it just allows for a better understanding of the types of strategies, the risk, especially when we go back to kind of our philosophy with using the bucket plan and segmenting money and really getting a deeper dive, peeling the onion back to give them an understanding of how to segment their assets, where to place their assets in the most tax efficient way in order to make sure that they are set up not for accumulation, but for distribution. And again, for not only distribution to themselves, but distribution upon their passing as well to the heirs. So yeah, that just popped up because there was a client that I was working with who kind of was on the other side of the thing. Like they were saying, listen, no, I need help. I don't really know where it is. They saved very well, and it wasn't that they wanted to be in control. They wanted help so that they were in control over the plan.
Yeah. Number six. Simplified estate planning. Now, whether you have one IRA or one 401k, but again, this is more for talking about consolidating your 401ks into an IRA. An IRA is just going to offer more flexibility, especially if again you're someone that has accumulated 2, 3, 4 401ks over your lifetime. If you have 4 401ks, 3 or however many, and you want to update beneficiaries, you have to update them on each account. Whereas if you had one IRA that held all of your retirement assets, and all of a sudden, your favorite nephew, niece, child, they're not listening, you want to update your beneficiaries, you're doing it one time. You want to update it to a trust or whatever the case might be, you're updating it once. It's not something that's forgotten. Oh, wait, did I update my third or fourth 401k to reflect the correct beneficiaries? It can get overwhelming. Now, that's just talking about designating beneficiaries. I've had a few occurrences over my professional career where it's a very emotional meeting with a widow, where they're bringing in bags full of old statements, and we're trying to figure out where the money is. And again, this kind of goes into communicating with obviously your spouse on where assets are and everything like that. But I remember calling Fidelity with a statement from the 80s to see if there was money there, and then we call Fidelity. Kudos to them; they were able to track down that there was a transfer to another retirement account sometime in the 90s. We called that company, and long story short, a few hours went by, and we were able to kind of track down all these accounts. But it's a lot easier if you do this along your working career. So right now, if you're in your 30s, 40s, and you have two 401ks, possibly consider consolidating them into one IRA so that if something happens to you, there's only one account that has to be called on. Because again, the last thing you want is to have loved ones searching through mail or things like that, statements. I remember again in that scenario seeing a statement that was older than I am, uh, and yeah, you just don't want to put your loved ones through that. So again, it's going to simplify your life, like Steve mentioned in point number one, but it's also going to help a lot when it comes to estate planning, just from designating beneficiaries, all the way down to possibly leaving money behind. It's possibly going to go past. You're not going to probably run into any probate delays or things like that. So again, we highly recommend talking to a professional to see if it makes sense to roll over your 401k into an IRA.
Yeah, and the beneficiary designation, that's a big one. Just overall, I know this is kind of off topic a little bit, but make sure check the beneficiaries. If you're talking with friends and family, make sure they check the beneficiaries. Just had a call a couple days ago, and it was one of our clients. Unfortunately, her brother passed away unexpectedly. He was in his late 50s, and he didn't update the beneficiaries properly. And long and short of it, now we're in a situation where we're trying to work through figuring out how to get the money to the right people, and so not to get too far off the path on this, but the bottom line is just make sure you update the beneficiaries, and it's something that is easy, but it's something that is also easy to do, but easy to forget to do. And that's a big one because the beneficiaries trump the will. So if the beneficiary says one person, but it really should go to two people or three people, it's really up to now that beneficiary to number one, feel that they want to disperse that money. But the second thing is there are tax implications that could occur, which could make it prohibitive or challenging for that beneficiary who inherits that money, even if they have all good intentions and understand that, hey, no, this isn't all my money. This should go to another brother or another sister or whomever. It just might be challenging to do so because of the rules and depending on the type of money that gets inherited, the taxation around that. And so it could just be a very difficult situation to unwind. So I just wanted to kind of mention that one too.
Yeah, absolutely. Yeah, and like we're just mentioning, like if you want to update your beneficiaries, it's pretty easy to do so if you only have one IRA to do that for, and you only have one login and one password to remember for that one IRA. And
Yeah.
we all are probably sick of having to create new passwords for that new website that now requires 5 special characters, but your normal password only has 2. It's a lot easier to remember if you only have to update one account and you only have to remember one login. But when you have to do it 3 or 4 times because you have multiple accounts, it can get pretty overwhelming. So that kind of goes over the 6 compelling reasons to roll over your 401k into an IRA, right? We have the simplicity, consolidating your retirement accounts, everything like that. Number 2 was your effortless RMD management. 3 was the greater investment flexibility. 4 was possibly lower fees or more transparent fees and expenses. 5 being your enhanced control and ownership, and 6 being simplified estate planning. But Steve, I remember there being a
Yes.
half. So what's our last tidbit of information here?
Drum roll, please. The one half. Thank you all for staying for this part. You're going to be rewarded with some really great information. So here's the thing. When to keep the money in the 401k. And the first reason why you'd want to do that is the rule of 55, meaning if you turn 55 or you're older during the calendar year and you lose your job or you leave your job, you can begin taking distributions from your 401k without penalty. When I mean the penalty, without paying the early withdrawal penalty, right? Because again, what's the age, Jeff, at which you can take the money out of a retirement account without
59
having
and a half.
without having the early withdrawal? That's right. Without having the early withdrawal penalty is 59 and a half. So you say, okay, well, if you're 55 or older, you lose your job. Well, you may need to either A, you may think about taking an early retirement. B, you may need to bridge the gap until you're able to find another job. And if you move that money to an IRA, well, that exception does not apply. So you can't take money from an IRA if you're older than 55. But you can take money from that 401k. And again, it's the 401k in which if you leave, and if again, 55 and older, you leave or you lose your job, you can begin taking those distributions. You will still be taxed on that money. You can't get around the tax man, right? He's going to come and take his portion because, well, you defer those taxes. You got that deduction. And so, yes, the taxes will be due, but that penalty, that early withdrawal penalty will not be due, and that's 10%. Right. So that's a reason why you want to leave that money in the 401k. So that's a big one. Just had a client a few months back. That's exactly what happened. We're leaving the money in the 401k just in case, because it looks like they will be okay and they have another job lined up. But we just want to make sure. Now you get another job. You can certainly feel confident that you're set to go. Income is coming back in. Then the conversation can resume. But I would kind of really be careful about moving that 401k, especially if you're 55 and you've just lost that job. Anything else to add to that one, Jeff? Otherwise, I'll go to the next one.
The 401k loan.
401k loan. Yeah.
If you have an IRA, you can't take money, or there's no such thing as an IRA loan, but you possibly could take out a 401k loan.
Yep.
If you're still employed there, and again, there's different parameters around that, but it's something that's offered on your 401k platform that is not offered on your IRA platform.
Yeah, and that's especially if more so, you're over 59 and a half, you're still working. A lot of times some people, they'll do in-service distributions, and if you do that in-service distribution, meaning once you're over 59 and a half, most plans do allow for you to do a direct transfer to an IRA, again, because of the reasons why, because of the reasons we just listed is really the reasons why these plans allow that, because they understand that planning is now taking kind of precedence in a person's life as they're older. They want to start to plan for retirement. They want more options. So if you move that money, you're not able to take that loan anymore. So you want to, if the loan is, or if you're looking to take a loan, just make sure that you leave a certain amount in that IRA, in that 401k to make sure that you can take that loan. Now the IRS has a max loan of $50,000 on a 401k as of currently. So just keep that in mind as well. But I would say the last one, as far as why to kind of keep money into 401k, is what's called a still working exception. So if you are getting close to your RMD age, so depending on your year of birth, it'll be 73 or 75. If you're still working at the company and you're working past your required minimum distribution start date, the RMD start date, which is April 1st, following the year that you turn 73, that's the required beginning date is what it's called. Whether that's 73 or 75, so April 1st of that year, you aren't required to take RMDs from your 401k until you actually retire from the job that you're working at. So again, if you're still working, you're approaching your RMD age, you now turn 73 or 75, you don't have to take that RMD from that 401k. So if you have other IRAs or other 401ks, you would have to, and when I say other 401ks, other old 401ks from previous employers, you'd have to take the RMD from those accounts. And we talked more about RMDs. I believe it was episode 7. And so if you have kind of questions about that, please feel free to go back to that episode and listen to that. But yes, you would have to take those required minimum distributions from those other accounts. But the 401k that you have with your current employer, you would not have to take that required minimum distribution. Now, when you do retire, yes, then you would have to go ahead and take that RMD. But it gives you some of that flexibility. It gives you the ability to postpone the RMD on that 401k. Flip side, if all your money was in that 401k and you're still working in that current employer's 401k and you're still working past your RMD age, well, guess what? You don't have to worry about an RMD. Now, delaying RMDs could cause some other issues, especially with the fact that as you get older, RMDs start to increase. So from a tax efficiency standpoint, there could be some challenges around that. But everyone's situation is different, and that's where you really want to look at it and make sure that there's a plan in place that addresses what we just spoke about, because that's a big piece, a very, very big piece.
The other thing, you really don't see it too much anymore because of just like the holdings within retirement accounts, but NUA, is that still
That's a good
I mean,
point.
I feel like, they keep changing the Secure Act, 19.0 or whatever might be coming out soon. They keep obviously changing the rules, but NUA, which we could probably do a whole other podcast on just on it, just because it is pretty complicated and it only applies to those that have a retirement account with a publicly traded company and own that company's stock within their 401k.
And
And
Jeff,
that's
the NUA stands for.
Steve. I went to a state college, man. Let me Google this. It stands for net unrealized appreciation.
We
It's a
have a
tax
winner,
strategy.
folks.
It's a tax strategy. And again, it's something that we'll dive into on another episode. But it's a benefit to you with the money in the 401k. If you transfer that money into an IRA, and still hold that company stock, you lost out on a possible tax loophole. So hopefully you're working with a great financial advisor like Stephen Benny. Um,
Don't sell yourself short. Jeff Costello,
but
you're wonderful.
I am short. I'm under 6 feet, but that's not here nor there. The That kind of concludes though our 6.5 compelling reasons to roll over your 401k into an IRA.
Yeah, and I think that the half kind of went a little more so. We could have made it 7, but I like what you did there with the 6.5.
Keep the I gotta keep the audience guessing at times. So again, reasons why: simplicity, effortless RMD management, greater investment flexibility, possible lower and transparent fees and expenses, your enhanced control and ownership, simplify your estate planning. But again, you also want to take all things into consideration based off your personal circumstances, because there are benefits, like Steve and I just went through, on keeping the money within the 401k. Now, whether you're 30 years old, 40 years old, 60 years old, 70 years old, this advice, applies to you. Otherwise, that kind of concludes episode 8. Steve, any last words for our audience?
Episode 8 is in the books. No, I hope it was helpful. Again, if there's additional questions, let us know. Send any topics over that you think would be helpful. We'd be happy to be able to dive into it. That's what we're here for. We're here to serve you, and looking forward to it, and we're excited to do so.
And again, any topics, please feel free to submit it through the website, wealthroadmappodcast.com. If you know any friends, family members, colleagues that may benefit from these podcasts, we encourage you to share. Otherwise, until next episode, take it easy, guys.
See you later.
thank you for joining us. If you enjoyed our podcast, don't forget to like, subscribe, and leave a comment on topics you'd like for us to cover on future episodes. We'll see you soon.
Financial planning and advisory services are offered through Prosperity Capital Advisors, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. One Team Financial LLC and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through One Team Financial LLC are not affiliated with PCA. Information received from this video should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including but not limited to age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. Content may have been created by a third party and was not written or created by a PCA-affiliated advisor and does not represent the views and opinions of PCA or its subsidiaries. For information pertaining to the registration status of PCA, please contact the firm or refer to the Investment Advisor Public Disclosure website. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form ADV from PCA using contact information herein. Please read the disclosure statement carefully before you invest or send money.